If a $5 million opportunity showed up tomorrow and required a 72-hour close, could you deploy that capital? If you have to ask someone for permission to move your own money, who's actually in control, you or them? At what point did becoming wealthy start to mean becoming slower? You see, wealthy people and institutions don't guess, they pre-position. And if you're not pre-positioned, the deal goes to someone who is. What I want to do here is show you something specific. Why some people can move in 72 hours when opportunity shows up, and why others who are just as wealthy on paper can't. Not because they're less capable, but because their systems were never built for speed. And that's the real difference. The ability to move fast isn't about hustle, it's a structural advantage. It's a form of capital in its own right, if you think about it. What this really comes down to is understanding why waiting exists at all. Not as a behavior, but as a structural outcome. Wealthy people don't wait, not because they're reckless, but because their systems don't require permission to move. By the end of this, you'll understand the structural difference between capital that can move and capital that has to ask. And if you don't own speed, someone else will use theirs to take what should have been yours. Speed isn't a luxury, it's capital. Let me take you back to 2008. Not to talk about the crash because you already know that story. I want to talk about what happened after. Specifically, who moved first, who moved fast, and who was still waiting for permission whenever the best deals were already gone. In the 6 months following the crisis, institutional buyers deployed over $400 billion into distressed assets. Blackstone raised a $10.9 billion real estate fund. Lone Star deployed $10 billion into distressed debt and real estate. Apollo moved $1 billion into corporate credit in weeks. Like, these weren't lucky guesses. They were pre-positioned systems, liquidity, legal structures ready, decision frameworks that didn't require committee approval. They were built to move in 72 hours, not 72 days. Now, contrast that with the average retail investor. Most people were paralyzed, not because they didn't see the opportunity and not because they didn't have capital, but because their capital was locked, tied up in retirement accounts that they couldn't access without penalties, sitting in brokerage accounts that they couldn't touch without selling at a loss, in real estate that they couldn't liquidate, or worse, liquid, but controlled by someone else who wasn't answering the phone. Institutions deploy in 72 hours. Retail waits 72 days. So while institutions were buying hotels at 40 cents on the dollar, and while they were acquiring commercial real estate portfolios in bulk, while they were locking in 20-year returns in weeks, most were still navigating the approval processes. And by the time they got their approval, the assets were already gone. The opportunities were just closed. The institutions that moved fast spent the next decade compounding those returns. This isn't about being smarter, and it's definitely not about having more capital. It's about friction, and friction is expensive. Institutions moved $400 billion. Retail couldn't move 5 million. Let's talk about what friction actually is. Most people think friction is just time. It takes a few weeks to get approval. I have to wait for the wire to clear. But if someone has to approve access first, then control isn't fully yours, no matter whose name is on the statement. Friction isn't just time. Friction is the gap between decision and execution, and that gap has a cost. Here's how institutions measure that gap and why it matters. First, they look at speed. Once a decision is made, how fast does capital actually move? On the institutional side, deployment happens in 48 to 72 hours. Private credit takes a little longer, 7 to 10 days. Retail banking, you're looking at 3 to 6 weeks just to get your own money moving. If you're outside that 72-hour window, you're not competing with institutions. You're waiting in line behind them. Second, they ask, how many approvals do you need just to move your own capital? 1, 2, a committee? At the institutional level, it's one decision maker. That's it. A family office with external custody, you're dealing with like 3 to 5 layers. Retail, it's multiple business days, sometimes with a required advisor consultation before you even see the funds. Each approval layer adds time. Each time layer adds cost. Each cost layer reduces your ability to capture asymmetric opportunities. And here's the thing about the best deals, they don't wait. If you're still watching, then we probably already agree on a few things. Wealthy people don't liquidate positions. They design systems so that selling is rarely required. Rich people sell assets. Wealthy people leverage them. And the best deals, they don't wait. They get taken by people who are positioned, not panicked. If you need permission, you've already lost control. Now let me show you what this costs in real terms. In private credit markets, there's something called the speed premium. That's the extra yield that borrowers are willing to pay for certainty and for fast execution. And it's not small. On average, it's 150 to 200 basis points. Now let's look at how this plays out. A private credit deal that can close in 7 to 10 days, the borrower is typically paying SOFR plus 475 to 550 basis points. SOFR, that's the secured overnight financing rate. It's the benchmark rate that most institutions now use instead of LIBOR. Think of it as the base rate, and everything else gets priced on top. But stretch that timeline out to 3 or 4 weeks like a broadly syndicated loan, and the rate drops to SOFR plus 325 to 350. That's a 157 basis point gap just for being slow. In high-stakes scenarios, borrowers will pay up to 250 basis points more just to close in 72 hours instead of 30 days. Why? Because in competitive auctions, in distressed acquisitions, in compressed timelines, speed is worth more than price. Now flip it. If speed is worth more than 2.5 points to a borrower, how much is it worth to a buyer? If you missed a $5 million deal at an 18% internal rate of return over 10 years due to a 60-day approval delay, the opportunity cost is $27.4 million in unrealized returns. Let me show you how that number actually works. A $5 million deal at an 18% internal rate of return generates about $900,000 per year. Miss that deal for 10 years, and that's $9 million in lost returns before compounding even shows up. But once you account for reinvestment, that missed return compounds into roughly $27.4 million. And at larger scale, the numbers escalate really fast. A $12 million opportunity delayed just 3 years can quietly erase 8 figures in potential gain. That's not bad timing. That's the cost of not being positioned. Put another way, that's the tax of waiting for permission. And again, that's not a theoretical number. That's what it costs to wait. But here's another cost that nobody tracks. And if you're like me, you'll probably find this the most fascinating and the most disturbing of all. Every hour spent managing bank relationships, things like assembling documentation, negotiating terms, waiting for committees, that's executive bandwidth not spent leading, doing things such as shaping strategy, moving capital, sourcing deals, building the future. Behavioral research shows that when 15% of your cognitive capacity is consumed by financial system friction, strategic decision quality drops by 30 to 40%. Let me just stop here for a second because what I just said might have slid right past you. And if it did, I need to bring it back real quick. When 15% of your cognitive capacity is getting chewed up by financial friction, your decision making doesn't just slow down, it degrades by 30 to 40%. That's not small. That's not like a rounding error. That's like trying to run a business on a laptop with over 40 different browsers open at the same time while you have Zoom running in the background. You can technically work, sure, but everything lags. Every click takes longer. Your thinking is choppy. Your system is strained. And you don't even realize how slow it's gotten until somebody hands you a clean machine and then says, try it now. That's what it feels like to operate without friction. You move quicker, you think more clearly. You don't just catch more deals, you make better ones. And that's what most people never get to experience because they think it's just part of the process. It's not, it's a tax. And the longer you tolerate it, the more costly it becomes. So you're not just losing deals, you're actually losing judgment. And it gets worse. The real cost isn't just one missed deal. It's the compounding effect of missing the best deals. I heard an interview with Jeff Bezos once, and he provided a framework for how he makes personal decisions. And what he said, it's always stuck with me. He said that oftentimes people's biggest regrets aren't the things that they try and fail at. They're the paths that they never took. And he said that that kind of stuff haunts you. And it's where you begin to wonder what could have happened. I loved that person, but I never told them. And it always stayed with me because missing one deal, sure, that's money. but missing the chance to move, to try. That's the kind of thing that you remember at 80. And that's what this is all really about. It's not about chasing risk, but not letting hesitation steal what should have been yours. Waiting for a crash isn't a strategy. It's just a delay. Wealthy people don't time cycles. They transcend them. They buy on the way up, they buy on the way down, because they're not chasing cheap. They're really securing quality. And if you're buying foreclosures, you're not buying high quality assets. You're picking through what the real buyers already passed on. The best opportunities don't show up on a schedule. They show up in windows, narrow windows. And if you're not built to move in those windows, you don't just miss a deal. You miss the deals that define decades. 2008 was one of those windows, and March 2020 was another one. The next one is coming. And when it does, the people who can move in 72 hours will capture generational returns. And the people who have to ask permission, well, they'll watch it happen. Friction looks like delay. Friction is structural failure. There's a moment in history that I think about more often than I probably should, and it's about Apollo 13. Most people remember that as a miracle, a story about courage, ingenuity, heroics under pressure, but that's not actually what saved them. With all due respect, that's not actually what saved them. 2 days into the mission, an oxygen tank exploded and the cabin went completely dark. I'm sure there were alarms and I'm sure there was chaos. The power, or the crew lost power. And in those moments, their panic would have been totally justified. But something amazing happened. They didn't scramble and they didn't guess. They followed protocol. Every action had already been rehearsed. Every failure had already been imagined. The system didn't rely on brilliance in the moment. It relied on decisions that were made long before the rocket ever even launched. Backup power, backup procedures, contingency plans that were baked into the architecture. Not because NASA knew it would happen, but because they refused to be surprised if it did. The crew made it home, not because they were lucky, but because they were protected by structure. Resilience isn't improvised, it's engineered. So how do institutions eliminate friction? It's not luck, it's not access, design. Specifically, they build systems for the worst conditions, not the average. Retail builds for average. Institutions build for crisis. Most people build their financial systems around what works most of the time. Money in accounts that are easy to access when markets are calm, credit lines that work when banks are lending, liquidity that's there when everyone else has liquidity too. Institutions don't do that. Wealthy people don't do that. Institutions ask a different question. What happens when everything breaks? So here's the crisis design question. If credit markets froze tomorrow, and if banks stopped lending, and if liquidity just completely disappeared, could I still deploy capital? If the answer is no, the system isn't finished. The wealthiest man who ever lived, his name was King Solomon. Adjusted for inflation, if he were alive today, his net worth would be well over $2 trillion. And there's a line in Proverbs that he wrote that's always fascinated me. And it says, "Go to the ant, consider its ways, and be wise." What's interesting is not that the ant prepares for winter. What's interesting is when it does. It prepares in the summer, and there's no threat in the summer. There's no urgency, there's no pressure. Food is everywhere. Conditions are easy, nothing is broken. And still, the ant is building reserves. Scripture makes a point to say something else too. It has no overseer. The ant has no ruler. Basically, no boss. Like, no one is telling it what to do, which means this isn't obedience. It's actually a form of self-governance. The ant doesn't prepare because it's scared of winter. It prepares because it understands seasons. It doesn't predict scarcity, it assumes it. And that's the difference between retail thinking and institutional thinking. Retail builds for what's happening, but institutions build for what always happens. So winter doesn't surprise the ant, and crises don't surprise institutions. Not because they know when they're coming, but because they refuse to be caught unprepared when they do. That's not pessimism, that's just wisdom. And that's why institutions don't rely on conditional liquidity. They build systems with contractual liquidity baked in. On screen, here's the contrast. Conditional liquidity looks like this. I can access my money if the bank approves it, if the market is open, if my advisor agrees. It's access with strings attached. Now, compare that to contractual liquidity. I can access my money because I own the contract. No approval, no market, no pessimism. That's the difference. Like, guys, that's the difference right there. Conditional liquidity works in good times. Contractual liquidity works in all times. If you control the infrastructure, you control your speed, and your speed is your power. Contractual liquidity follows 4 laws that institutions don't break. They're called the 4 laws of true liquidity. Law 1, access without selling. If you have to sell, trigger taxes, or get penalized just to touch your own money, that's not liquidity. That's a leash. The wealthy never interrupt compounding for access. They borrow. Privately, silently, tax-free. Law 2, borrow while it grows. If you have to spend it to use it, that's not true liquidity. It's liquidation. True liquidity means borrowing against the asset while it keeps compounding. Interest isn't a fee, it's the cost of controlling capital without giving up ownership. Law 3, it's not tied to Wall Street. True liquidity doesn't ride the roller coaster. When markets drop, it stands still, or it moves on your command. If your emergency capital is tied to the crash, you don't have an escape plan. You've got a parachute full of holes. And Law 4, it holds its value in a crash. If it crashes, when the market crashes, it's not true liquidity. It's just exposure. Institutions don't gamble with reserves. They fortify them. Because if you can't count on it in a crisis, you can't count on it at all. These aren't features, these are non-negotiables. If your system breaks down even on one of these laws, it's not a real reserve, it's a bet. And institutions don't bet on liquidity, they engineer it. So what does this look like in practice? Stack, shield, scale. This is the capital operating system that I build and teach. Built for people who want speed, liquidity, and control without selling what they've built. It's a 3-part system: stack, shield, scale. Stack is the foundation, a stable, liquid, compounding reserve. This is your war chest. Most people spend income. The wealthy redirect it. Stack builds a reserve that compounds without interruption. It stays collateral ready, and it becomes the base layer of everything that follows. Shield comes next. It's about activating leverage without giving up growth. The wealthy don't sell assets, they borrow against them. Shield means you keep compounding, protect yourself from taxes, and maintain control, no matter what the market's doing. Scale is the final loop. You reinvest cash flow returns and tax savings, not new earned income. Refill the war chest, expand again. Every cycle builds speed, velocity, and freedom. Stack, shield, scale, repeat. That's how the system starts feeding itself, and how compounding and cash flow finally work together. The wealthiest operators never liquidate, they leverage. This isn't taught in business school, and it's definitely not promoted by retail banks, but it's exactly how endowments, family offices, and institutions stay liquid through every single cycle, because they're not building for convenience, they're building for survival. Here's what institutions understand that retail systems ignore. Banks are required to maintain what's called a liquidity coverage ratio. These are liquid assets that can cover at least 30 days of stressed outflows. The minimum is 100%, but most major banks hold 110 to 150%. They don't optimize for the average day. They optimize for the day that the phone stops ringing. That's not regulatory compliance. That's institutional doctrine. The question is, do you have a liquidity coverage ratio for your own life? Laws define what's possible. Systems make it inevitable. Let me tell you why this matters. Not in theory, not in hindsight, right now. If failure isn't an option, copy what institutions do. Institutions don't play to win, they play to never lose. They're built for survival, not convenience. They hold liquidity when others chase returns. They manage risk like it's oxygen. They grow through every single storm. That's why we mirror them, and that's what we copy. Because they build systems that outlast men, markets, and governments. Think about it this way. If you had to survive every crash, if your capital had to support generations, and if failure wasn't an option, would you guess? Would you chase? No, you would engineer certainty. That's what institutions do. That's the playbook. That's what we steal, and that's what we copy. So let's go back to the question I asked at the beginning. How long would it take for you to deploy $5 million if the opportunity appeared tomorrow? If your answer is anything other than 72 hours or less, you're not built for crisis, you're built for average. And average doesn't capture asymmetric opportunities. The institutions that deployed $400 billion in 2008, they didn't get lucky. They were pre-positioned. Like Solomon's ant, they didn't wait for winter to start moving. They had reserves that followed the 4 laws. They had systems that operated without approval. They had speed as a competitive advantage. And when the opportunity came, they didn't have to ask, they just moved. My name is Christopher Hemrick. I'm the founder of the War Chest Principle. I build capital systems for entrepreneurs who are done waiting on banks and tired of asking for permission to move capital that they already control on paper. I study how institutions build access, how they borrow without selling, how they deploy in 72 hours, and how they move with 0 delay. Then I help private operators and entrepreneurs do the same thing so they can move, acquire, and deploy without ever needing to liquidate or explain. This is the second video in a 3-part series. In the first video, we talked about the hidden tax of asking permission. How every time you have to ask an institution to access your own capital, you're paying a cost in time, attention, flexibility, and strategic optionality. Today, we talked about what it costs to wait, how friction compounds, and how speed is a form of capital, and how institutions eliminate that friction by design. In the next video, we're gonna build the system. We'll walk through exactly how to construct a reserve that follows the 4 laws, operates without approval, and lets you move in 72 hours, not 72 days. Because once you see how it works, you'll never look at capital the same way again. You've earned your income. Now it's time to earn your freedom by thinking the way that institutions do, by building a system that works without you, and by protecting the one thing you can never earn back, your time. If this hits home, subscribe. This channel is small for now, but not for long. I only teach what the wealthiest families and institutions and wealthy families actually do, because they've figured out what works, and I think you deserve the same. Keep building for the generations you won't meet until you meet in heaven. God bless.